Hello everyone, welcome to your Algo lab. Today we're diving into macro algo. We'll explore the US presidential cycle and see how you can use it to make your investment decisions. The US presidential cycle refers to the recurring four-year pattern that influences both politics and economic policies, often impacting stock market behavior. We've compiled a table dating back to 1969, outlining each four-year presidential cycle along with the average likelihood of achieving positive market returns. We can observe a pattern in how the US presidential cycle correlates with stock market performance. In the first year, market performance is usually moderate as the new administration begins implementing its policies. The second year often sees more market corrections or slower growth, particularly in the run-up to midterm elections. By the third year, markets typically perform well as the administration shifts its focus to economic growth and voter-friendly policies ahead of the next election. In the fourth year, performance tends to remain stable, though election-related uncertainty can introduce some volatility. We have compiled a similar table for the US dollar. The US dollar often experiences weakness during the midterm election year due to uncertainty surrounding the outcome. However, in election years, the dollar tends to strengthen. One explanation for this is that a strong dollar boosts domestic consumption, which in turn supports economic growth, benefiting election candidates. Let's take a closer look at the presidential four-year cycle. We've averaged all the cycles since 1969, with the average cycle represented by an orange solid line and the current cycle from 2021 to 2024 shown by a blue solid line. Let's start with the post-election year. The newly elected president takes office in January of the following year, introducing new policies and economic reforms. These may involve changes to taxes, regulations, trade policies, and government spending. Historically, this year is often viewed as moderate for the stock market, as the implementation of the administration's policy agenda can create short-term uncertainty. Next is the midterm year, which occurs in year 2 of the cycle. During this time, voters elect new members to the US House of Representatives and 1/3 of the Senate. The results can shift the balance of power in Congress, potentially limiting the president's ability to pass new legislation. Historically, the stock market is weaker in the first half of year 2, often referred to as the midterm slump, due to uncertainty surrounding the election outcome. However, the second half of the year typically sees stronger market performance. Depending on the election results, the president may adjust policies to work with the new congressional makeup or face challenges from an opposition-controlled Congress. Next is the pre-election year, which is often viewed as a time of economic growth and stock market recovery. Historically, presidents introduce market and voter-friendly policies to strengthen the economy in preparation for the upcoming election. Year 3 tends to be one of the strongest for the stock market, as the administration typically prioritizes growth-stimulating measures, such as increased fiscal spending and favorable tax policies, to ensure the economy is in good shape before the election. Then comes the election year. The focus in the final year shifts toward the upcoming election. If the sitting president is running for re-election, their policies tend to focus on maintaining economic stability and favorable voter sentiment. Historically, markets tend to perform well in the fourth year as economic stimulus and market-friendly policies continue, but volatility may increase as the election approaches, especially if the race is tight or there is uncertainty over potential policy changes. Now let's take a closer look at the election year, considering two possible outcomes, whether the incumbent party wins or loses. When the incumbent party retains power, the stock market usually responds more positively. This is because investors value stability and continuity, with the incumbent's policies already familiar and understood, reducing uncertainty. On the other hand, if the incumbent party loses, the market tends to become more volatile. This increased volatility is driven by uncertainty about the incoming administration's policies, including potential changes to regulations, taxes, and fiscal strategies. While the presidential cycle offers a useful framework for identifying potential patterns, it does not guarantee future market or economic outcomes. As numerous factors can influence these cycles, it's best to consider other macroeconomic or technical indicators alongside it for a more comprehensive analysis. Don't forget to check out our other videos. If you enjoy our content, please like, subscribe, and hit the bell icon to stay updated with our latest releases. Thank you for watching, and see you next time.